Understanding Market Irrationality, a Beginner's Guide. Welcome to this video on investment wisdom, where we'll unravel one of the most important lessons for beginner investors, understanding market irrationality. Inspired by the timeless words of economist John Maynard Keynes, markets can remain irrational longer than you can remain solvent. We'll guide you through why markets don't always act logically and how you can navigate the challenges this presents. Investing can be both exciting and overwhelming, especially when the market doesn't behave as expected. This video will teach you why betting too heavily on short-term predictions can be risky and how you can make smarter, long-term decisions. By the end, you'll have a solid foundation to confidently approach market uncertainties. Let's begin by defining market irrationality. A market is said to be irrational when its movement or valuation doesn't align with logical explanations or expected fundamentals. Simply put, prices can rise or fall in ways that don't seem to make sense. For example, you might see a stock or cryptocurrency that appears vastly overpriced, and yet its price continues rising. On the surface, you might think, this can't last. It's bound to crash any minute. But irrational markets can sustain this behavior for far longer than you'd expect, as prices are often driven by emotions like fear, greed, or pure speculation. Take the cryptocurrency market, for instance. Prices often surge dramatically because of hype, even if the underlying technology hasn't yet proven its value. The same happens in stock markets with phenomena like meme stocks, where online communities drive prices sky high, ignoring traditional valuation principles. Understanding that markets don't always follow logic is your first step toward avoiding costly mistakes. Let's dive deeper into why this happens and how it affects your investment strategy. If markets are supposed to reflect the true value of assets, why do they sometimes act irrationally? The answer lies in a mix of human psychology and external factors. Investor psychology. Emotions drive decisions more than rational analysis in many cases. Greed can push people to buy into overvalued assets, while fear can lead to panic selling, driving prices down unnecessarily. Speculation. Markets often respond to speculation rather than facts. When enough people believe an asset will rise, their collective buying can create a self-fulfilling prophecy, at least temporarily. External events. News headlines, political developments, or sudden economic shifts can cause irrational surges or drops in markets, regardless of the asset's fundamentals. For beginner investors, the challenge is how to respond to these unpredictable behaviors. If you assume the market will behave logically, you're likely to be caught off guard. This brings us to an important caution: the dangers of betting too heavily on short-term market movements. It might seem intuitive to act quickly on an assumption about market behavior, like shorting a stock you believe is overpriced or buying into a cryptocurrency during a hype cycle. However, short-term predictions come with significant risks. First, timing the market is incredibly challenging, even for seasoned investors. While you may correctly spot an overvalued or undervalued asset, there's no way of knowing how long the irrational trend will last. It's possible for overvalued assets to continue soaring for an extended period, leading to substantial losses if you bet against them too early. For example, during the dot-com bubble of the late 1990s, many technology companies were massively overvalued, and yet their prices continued to climb for years, defying expectations before the eventual market crash. Investors who assumed the bubble would burst quickly were the ones left struggling to recover. The lesson? Don't bet too heavily on short-term movements. Even your most rational predictions might not align with unpredictable market behavior. Instead, successful investing requires a longer-term, balanced approach. To help you navigate market irrationality, let's break down 5 foundational lessons every beginner investor should remember. Lesson number 1: timing the market is extremely difficult. Market behavior in the short term is often influenced by emotions, speculation, and noise, rather than solid fundamentals. Don't assume you'll be able to perfectly time when a stock or other asset will rise or fall. Lesson number 2: avoid overconfidence in predictions. It's easy to feel confident after reading a few headlines or following social media trends. But the truth is, even experienced investors with vast resources can't always predict what will happen next. Lesson number 3. Diversify your portfolio. Putting all your money into one or two assets is a risky strategy, especially in unpredictable markets. Diversification spreads your risk so that no single investment can dramatically impact your financial health. Lesson number 4. Focus on long-term strategies. The goal should be building wealth over the long term, not trying to get rich overnight. Investments driven by hype or short-term trends rarely provide sustainable returns. Lesson number 5. Be guided by research, not speculation. Do your homework. Researching an asset's fundamentals, such as its revenue, leadership, or growth potential, will give you a stronger foundation than relying on speculation or rumors. By keeping these lessons at the forefront of your approach, you're far less likely to fall victim to the pitfalls of irrational markets. Now that you understand the principles behind market behavior, let's explore practical steps you can take to become a smarter, more confident investor. Step 1. Create a clear investment plan. Map out your financial goals, time frame, and risk tolerance. Are you saving for retirement? A big purchase? Or are you seeking moderate, steady growth? Having a clear plan will help guide your decisions. Step 2. Allocate your resources proportionally. Avoid putting too much of your money into a single stock, cryptocurrency, or asset class. Instead, spread your investments to minimize potential losses and maximize opportunities. Step 3. Manage emotional responses. Market highs and lows can trigger strong emotions. You'll feel tempted to buy when prices soar or sell in panic during a dip. Resist acting impulsively during these moments. Staying calm and sticking to your plan will serve you well. Step 4. Regularly review, but don't overreact. Periodically check your portfolio to ensure it aligns with your goals. However, avoid making drastic changes due to short-term market events. Adjustments should be based on thoughtful analysis, not fear or FOMO, fear of missing out. Step 5. Stay informed through reliable sources. Educate yourself by following trusted, unbiased financial news and analysis. Avoid overly dramatic headlines, which often sensationalize short-term movements and fuel irrational behavior. These steps will not only protect you from common pitfalls, but also empower you to take control of your financial future with confidence. If you're feeling overwhelmed by the idea of unpredictable markets, know that you're not alone. Nobody, not even the most experienced investors, can predict every market movement or avoid every downturn. What sets successful investors apart is their ability to stay patient and disciplined. It's perfectly normal to encounter setbacks or make mistakes along the way. Learning is part of the journey. Keep in mind that financial success isn't built on a streak of perfect predictions. It's built on resilience, strategy, and time. The market might not always behave logically, but your approach to investing can. By understanding and accepting market irrationality, you'll set yourself up for smarter, steadier decisions. Let's recap the most important lessons. Markets can remain irrational for far longer than expected. Short-term predictions are risky. Focus on long-term strategies, patience, and disciplined investing rather than chasing quick gains. Avoid impulsive decisions by diversifying, doing your research, and following a balanced plan. Stay informed and approach market fluctuations with a calm, thoughtful mindset. Keynes' quote is a valuable reminder that even when the market seems illogical, you can outlast the chaos with the right strategy. Thank you for joining us on this beginner's guide to market irrationality. By applying the insights and steps we've discussed, you're already moving closer to becoming a confident long-term investor. Remember, successful investing isn't about predicting the unpredictable. It's about staying informed, staying disciplined, and never letting market irrationality shake your resolve. Your journey to a brighter financial future starts today. Keep learning, keep growing, and we'll see you in the next video.